Welcome to the Real Estate Crowdfunding Show syndication in the digital age at gowercrowd.com. I am Adam Gower, and today you are going to learn everything you need to know about how to raise money from foreign investors at lower cost of capital, with vastly larger checks, and without ending up having to run your deals by committee. Disclaimer: what you're going to learn today does not free you from having to build an outstanding digital presence online, because no matter who you go to for your capital, they're still going to be researching you on the internet. In fact, there's even a case to be made that especially with overseas investors, you want to have a particularly strong digital presence, because while you will meet them, get to know them and build a relationship with them when you meet them in person, with the physical distance between you and them, you will still want to remain top of mind. And the best way to do that is with a digital marketing campaign that is hyper-focused on your target audience, even if they are thousands of miles away. To find out exactly how to do that, sign up for the whiteboard workshop on the podcast page for today's episode at gowercrowd.com, where I walk you through the exact process step by step. All right, so now it is my great pleasure to introduce you to Michael Campbell of the Carlton Group. Michael is one of the foremost experts in the country on raising capital from foreign investors. You're going to learn today how you can raise money at lower cost in equivalent amounts as you could from institutional investors, and yet not end up with a project that you cannot run independently, but instead to continue to have full autonomy on how you run your deals. Ladies and gentlemen, this episode is specifically for my listener, Laura Macajon, and her question about the benefits of working with foreign investors, and so that she can take a closer look at this important option, I'm very pleased to welcome to the show Michael Campbell, CEO of the Carlton Group. Michael, what a pleasure it is to see you again. We had a really good call last time that was mostly introductory to Carlton Group. And I'll put a link to that in the show notes for anybody that wants to listen to that introductory conversation. But today, what I'd really like to talk about is your expertise in foreign inward investment into commercial real estate in the United States. Let's start off with this question: why is there international interest in US commercial real estate? What are the motivations that drive people to want to buy real estate here?
Well, mostly from the foreign investors, as always has been the safe haven for them to to make investments into the U.S. because they view U.S. as a safe country versus their own sometimes, or other opportunities that they have. And that's probably one of the biggest reasons. But they can also write bigger checks. A lot of these foreign groups, they want to write big checks, and it's easier to do in the United States than it is elsewhere, because assets here sometimes are expensive, or you can buy big portfolios, etc. But it's mainly because they view it as a safer haven for them to make investments and diversify.
And what about relative returns relative to where they are?
What they want, you mean? I mean, their returns the returns that they require. I mean, obviously their hurdles are lower than what traditional U.S. investors would be. So they don't really have to get maximum return in a deal. They're looking to get they do development, but they also do existing cash flowing deals. What they're looking to get a good yield, but doesn't necessarily have to be a yield that American or U.S. groups would focus on, which is a lot of times why the foreign groups outbid the U.S. groups, because the foreign groups can pay more because their yield requirements are less. I mean, so if it's for an example, if it's a development deal, a U.S. group may want to get like a 20% IRR. A foreign group, they could be happy with 12. And, if it's a cash flowing deal, some groups in the U.S., they may want to get a, 6 or 7% cash return. The foreign groups could be happy with 4%. It really depends on which part of the world they're coming from, especially from the European markets now. Where they have negative interest rates. If they get 4%, they're very happy. with the returns they can get here. So they're willing to, that's why if there's a foreign group bidding on an asset, typically, they're going to win the deal because they're going to be able to pay the most
And what
in the
about
price.
and what about direct investment with local sponsors or domestic sponsors? They're also willing to take lower returns, are they typically?
Well, I mean, a lot of times, a lot of times if they partner with a JV, if they JV with a local partner, for example, a lot of times what they can do is, the promotes that the local partner can earn from the foreign investor are higher because the foreign investor wouldn't necessarily have to get, like I was saying before, wouldn't necessarily have to get the return a U.S. investor would achieve. So they sort of compensate. So basically, so the local investors still make out pretty well because their promotes are larger. The returns they have to pay to the foreign investors are way lower. And so the foreign investor, the local investor, even though it's maybe a higher price, for that they have to pay for the asset, they're still doing pretty well on a promoted level for the JV guy.
Oh, interesting. And what about motivation to move to the United States?
Motivation? What do you mean?
In other words, that investors will invest here in order to get a passageway or a pathway to migration, to immigration, like the EB-5, for example, or other examples.
EB-5.
Yeah.
Yeah, a lot of, that's really more for, I guess, I've only seen it through the EB-5, where it's individuals, or families that are looking to get the visas, so there's the visa card program. But mostly we deal with those, individual guys, but, we're not really, the people that invest with us from the highway networks or the family offices, they're not investing in the U.S. to get visas. Most cases they're they're a very successful family office already, so they typically they may already have the visa or whatever they need to have to come to the U.S. already. But a lot of the groups we deal with are the institutions, and obviously it doesn't matter for the institutions. They obviously they don't have any visa issues. They just want to invest.
And what kind of partners are they, Michael? Are they passive? Do they also want to JV or invest with a local sponsor and then operate by committee? Are they more hands off? Give me a kind of paint the picture of how they operate.
In most cases, the foreign investors are very hands off. Because typically, if it's in the U.S., it could be anywhere from 9 to 13 hours in a time difference. It's harder for them to be hands-on when it's like that. Which is why it's very important that they partner. When they do partner, it's someone that's has a track record, because they're pretty much relying on their partner locally to execute the business plan, to asset manage the property, whatever they're doing. They rely heavily on the actual local partner, and that's probably more than 50% of their underwriting is really underwriting their local partner, because they can't be hands-on and they can't be the big brother, doing directing them week to week what to do, which gets to which is another point, is that's why the local guys that we deal with that we're looking for partners, they love foreign investors, because they don't have someone over their shoulder directing them, telling them what to do. They're the experts, so to speak, the local guy, and they get to do the right thing without having someone to tell them what to do, so to speak. It's also within a business plan that they, that they approve with the investor, the foreign investor. They pretty much just run the show without having Big Brother pretty much like watching over them.
Right, because this is something you and I've discussed, in fact, with folk who will remain nameless, but who know who they are as they listen to this. Right. Institutional capital likes to be highly involved, right? You get like execution by committee, right? It's not the idea,
right?
Like every major decision of a big tenant or upgrades or whatever kind of improvements there needs to be, everything has to be done by a committee. What you're telling me is that foreign investors, local sponsors don't have to worry about that with foreign capital. Is that correct?
That's correct. I mean, it's less of a committee. I mean, there is in the beginning they have to agree on the business plan, but it's not, they don't have to get everything approved from the foreign investor, because they really are passive. You know, a lot of, we've done, you know, plenty of deals with investors, and our clients have told us we love this the investor you brought us because we never hear from them. You know, it's like, you know, once a year, you know, they get a memo or something, but they never hear from them, which is what our guys love because they can just do what they need to do to make the project successful without having someone to tell them what to do. I mean, most of the local guys we deal with love the foreign investors for that reason.
All right, so let's drill down on this a little bit, Michael, because this is a very interesting point. So when we talk about foreign, it reminds me of what it was like when I lived in Japan. There were only two, what they used to, well, I got to be careful what I say, but there was the Japanese saw the entire world as being foreign. Basically, it was Japanese and foreigners. But we're hearing, because this is very, you know, the Japanese have been isolated on an island for 400 years. So it became this very close-knit community. Whereas here in America, we are a, you know, melting pot of hundreds of countries and cultures from around the world. So let's get a bit more specific. When we talk about foreign investors, which countries are particularly active right now here in the United States? And then let's talk about the trends and how that's changing and how it has changed.
Okay. So who we deal a lot with recently, who is very active in the U.S., you know, there's two Asian countries, which is Japan, South Korea, and Singapore. They pretty much have been the biggest replacement for China. As you know, China is, you know, nothing from China in years. But Singapore, South Korea, and Japan have pretty much filled the gap where China used to play in before. And they're very active. They want to see, you know, they want to do bigger deals. You know, they want to do. I mean, they want to do, you know, like all the deals we show them. They want to figure out how to make it work. So that's probably the most active now that we're dealing with from the foreign side. That being said, you know, there's also activity coming from Saudi Arabia, and you know, in the Middle East. You know, it's, you know, everyone, you know, knows about Abu Dhabi and, you know, and Dubai and Kuwait or whatever. But the real money for the Middle East is really in Saudi Arabia. I mean, that's where the real money is, and that's where a lot of the times they're coming in, you know, privately, so to speak, whereas they don't want to make big announcements that they made, you know, investments in certain deals, but the money is in Saudi Arabia from the Middle East. That's where all the big deals are getting done with.
That's really
And
interesting.
somewhat in Europe, but you know, Europe is probably more. It's probably the third of the list in terms of active in the U.S. so far. I mean, we are hearing a lot of activities from some of the large pension funds in Europe, mainly in the Nordic region. You know, where we are seeing more activity from them to want to come into the U.S. But they typically are more focused on buying or investing in, you know, Class A product, like a Class A office building, so to speak. Mostly it's office or some type of industrial logistics components. Is really what they're focused on. They're looking for deals that don't have a lot of risk. You know, it's well leased, Class A, and it's not a lot of lease up risk and so forth. But Asia and the Middle East, you know, they would take different risk on the lease up aspect.
Okay, so that's actually what I was actually getting at, was the different characteristics of the different types of investors. So, but before we get into that, and by the way, if you hear me tapping out on my computer, it's not because I'm like sending emails or anything. I'm just taking notes, just so you know.
No worries.
In the background. So let me ask you this. First of all, I'm interested. So tell me about how China has, or Chinese inward investment to the US has changed, because I was working for a Hong Kong-based fund not that long ago, and there was a lot of Chinese capital coming in to the US. So just explain how that has changed, and you know, the kind of waves that you see in terms of where money's coming from over time.
Sure. I mean, mainland China, you know, there's like zero money coming to the U.S. So that I've seen, you know. But you mentioned Hong Kong, which I always sort of put them, you know, they're separate in my mind. But Hong Kong, actually, there's still activity from some of the Hong Kong investors in the U.S. because they're not part of mainland China, so to speak. But China itself is like zero.
When did that stop, Michael? When did that stop? Because they've been a huge investor here in the States.
China?
Yeah.
They probably stopped 2 years ago. Whenever they started slowing down 2 years ago, but last year I'm not even sure if there was a deal done with Chinese, equity invested in the U.S. And a lot of the assets that the Chinese investors owned in the U.S. they pretty much have been forced to sell the assets from the government. They had to diverse out of the U.S. real estate, and they've had to sell, and a lot of times they had to sell at losses, unfortunately, because they just had to get out of U.S. real estate.
And that's because of Chinese legislation, right? Or Chinese regulation.
Correct.
Repatriating.
For the most part, correct. I mean, it's unfortunate. A lot of them pay very big numbers, especially in the New York City office buildings, and they had to, sell at big losses. We're talking about, hundreds of millions of dollars of losses here, just because they had to get out. So they're done right now in U.S. real estate. China.
Say that again. They're done. Is that what you said?
They're done. They're done investing right now. Unless things change, but right now there's no new inflows from China.
That's interesting. Okay, so you're seeing it picked up by Japanese, Singaporean, South Korean capital primarily. So do these guys do they prefer to invest directly and buy assets directly and then have a management company look after it? Or do they invest as equity with a local sponsor?
It varies. There are some groups in Singapore that want to buy direct and they want to run it themselves, some of the larger, funds. But for the most part, they still want to partner with someone local just because, especially if they don't have a presence like an office here in the U.S., especially when that's the case, they want to have a local partner. But some of them do buy direct, don't get me wrong, but for the most part, they want to partner.
And is it equity or debt or a mix of both?
It's both. Probably equity is more from, equity comes from, like I said, from all three countries I mentioned, Singapore, South Korea, and Japan. They all would do equity for certain deals. South Korea actually is probably bigger on doing debt. Debt, being first mortgage and mezzanine on deals. And South Korea also was, a little bit more focused on development deals.
Is that right?
On the debt side. On the equity side, they would buy existing deals, but on the debt side for South Korea, they really are doing a lot. We're actually doing a lot of deals with them, where they do, a first mortgage and a mezzanine loan on a construction deal, from a hotel to office to to a multifamily project, and which is good. And the reason why our clients, I wish we could get a mezzanine loan from someone from here, but the rates are a lot cheaper. Than they're more competitive on the mezzanine pricing than a U.S. mezz fund would be. So that's why, a lot of these groups are using South Korean, debt because it's just, cheaper.
That's interesting. And the terms are comparable with local lenders?
Well, the interest rates are cheaper, but, it's the same type of all the other components of the financing, the 3 to 5 years of the construction with extensions, et cetera. All that's the same as a U.S. lender, but the interest rates are just less.
Okay, and the controls also pretty much standard, pretty much the same.
Correct. I mean, they still want the intercreditors for the mezz and everything like that, but it's all about the interest rate, to be honest. Otherwise, it's like a traditional mezz lender from the U.S. Structure-wise, is just the rates are less.
And what about value add? So you've talked about Class A coupon clips, right, for yield, and ground up, which obviously is opportunistic or however you want to call it, right? Anyway, higher risk.
Right.
But what about value add, that middle ground where you're looking at a redevelopment deal of potentially a Class A building downtown that is currently in Class B condition?
Yeah, I mean, I sort of lumped that into like the development component. I mean, it was still, it's a different asset class, so to speak, because it's existing, but you're adding value. But they're still active in that too. I mean, that's to them that's easier to do than developments, because they can still get a little bit higher return, although it's less than what the U.S. guys would want. But it's still, something that they seek out, and especially in the multifamily arena. I mean, we probably are seeing a lot of interest from the foreigners to do, Class B multifamily value add, to make it from a Class B to a B plus, or B minus to a B plus, to add value. We're seeing a lot of interest from the foreigners to do those type of assets, and it doesn't have to be in a gateway city either. I mean, it could be in a portfolio or assets that are in with Texas is a good market, obviously, but for multifamily. But a lot of it doesn't have to be historically. The foreigners only focused on the gateway cities like L.A., San Francisco, D.C., and New York. Not anymore. Now we're doing deals with foreigners in Daytona Beach, Florida, for example. We did a deal 6 months ago, a ground up multifamily in the suburbs of Daytona with a Singapore investor, a high net worth family. So this they just knew Florida. They didn't know where Daytona was, but they knew Florida, and that's an area that they wanted to invest in. So it's plenty of deals in Texas too, with a lot of value add opportunities in Texas.
That's interesting. So
foreign groups like them.
Well, you've segued perfectly into actually my next question. That was, so what kind of asset classes, if you were to put them in any kind of hierarchy, what kind of asset classes are preferred by foreign investors? And what kind of geographical locations? I mean, you've touched upon that. Let's drill down on that a little bit.
Sure. I guess, there's always interest in Class A office, Class B office, value add. That's an asset class that they understand in their countries because they have them there. Multifamily is very interesting to them also, but I think a lot of times in the foreign countries they don't have a lot of rental properties themselves. I think everyone buys their individual condos, and then people own the condos. They may rent it out, but there aren't a lot of entirely all rental buildings in some of these countries because it's not what they do themselves. But they're definitely interested in investing that in the U.S. because they see and understand how that's how that's a safer asset class. For them, and it's just something they're really focused a lot more on recently, even from ground up development of multifamily to value add multifamily, and occasionally they would want to do a Class A stabilized multifamily project or tower, but historically they would do the Class B value add or development.
And when you
anywhere in the country,
anywhere in the country, is that right? Okay.
I mean, obviously, I'm not sure if they're going to be doing any deals in Kansas or places like that, but for sure the secondary markets in the U.S. 100%.
And are you when you start talking to these investors, are you noticing that they are selecting real estate or comparing real estate returns and opportunities here in the States with other industries that they could be investing in here in the States?
You mean other industries, not real estate?
Yes.
Is that, yeah. I don't know. I mean, we don't really, I just talk to them about real estate. They never bring it up to me that, that they can buy a company or whatever, make the same return. They never bring it up to me, but they may do it internally. But they have a strong interest in real estate. I mean, I'm sure they invest in other companies, but real estate's at the top of their focus.
All right. So tell me, what is the impact of foreign investment on U.S. commercial real estate, right? Like, for example, volatility or price inflation, etc. What is the, kind of give me, four components of the impact, if you like, of foreign investment.
I mean, for sure, what has happened because of the foreign investor groups, it's made things expensive, for certain asset classes. Multifamily, for example, it keeps getting more and more expensive because there's so much competition to buy the assets. Even with the U.S. investors, but now when you throw in a foreign investor who wants to start doing it, start making these types of investments, it makes it even more expensive because there's more competition for the same product. I mean, we're seeing that in office buildings. We've seen that in multifamily. And I think we're starting to see more of that in the industrial logistics aspect because that's something also everyone in the world probably is now trying to get on the bandwagon, like the Amazon effect, where everything is online, so to speak, where we need warehouses, logistics, all that's it's like a growing field, and a lot more interest keeps coming from investors to do those type of assets going forward. I don't think they've actually done a lot 2 years prior, but they're definitely focused on that asset class now.
So that's okay. So actually that was, we were talking about that, the different asset classes. So industrial, what about medical office buildings or senior housing or any of these other asset classes? That's something you've seen?
Well, senior housing, yes, because I lumped that into the multifamily, bucket because to them it's rental apartments for a different age group. It's still
Right.
it's still active. Medical office, we don't really do any of that. So I can't really speak to that aspect of it. But we have done assisted living, which is like the next level above senior housing,
Right.
where it's more of a medical aspect to it. But that's probably the most we've ever done in the medical field, because we have plenty to do in the office, industrial and multifamily. So it's more of a specialized asset class that the medical office is.
So I remember in my career started anyway, big time, during the 1980s when I was raising a lot of money from Japanese investors. I saw a lot of price inflation with all this capital coming out of Japan, particularly in
Right.
California, but I'm sure in other parts of the country as well. But then there was also a recession. Their exit from the market actually had an accelerating effect on the downturn, right? That came from the savings and loan in the 90s. You're too young to remember that, Michael,
Right.
I know. But so when you
Right.
talk about Chinese investors pulling out and taking huge losses, does that have a depressing effect, or are they just bringing prices back down to where they should have been in the first place?
I think it's probably bringing them back down to where they should have been in the first place. I'm not really seeing any other negative effects, aside from that. Everyone knew when the Chinese were buying these assets that they were overpaying, so to speak. But they basically brought it down to where they should have been. It's not like it's, a recession type of effect because they're exiting.
And so will foreign investors invest in funds or single assets? If you've got a sponsor that's putting together a fund, let's say, for example, a multifamily fund with a particular strategy on the West Coast, to pick something at random, right? Is that something that they will look at, or do they want to have a yay or nay say in each individual asset?
Well, we don't really do a lot of funds, raise funds, so to speak, at all. But and I know the foreign investors do invest in funds, but the groups that we deal with, what they wanted, their preference is to, like I was saying before, 50% of their underwriting or more is the local partner. They like to do all their underwriting on that one partner, and to do multiple deals with them. So it's not so much of a fund, so to speak, but they don't want to do just one deal. They would want to do multiple deals with this local partner over and over again. But they would still like to say yay or nay for the assets. Unlike if they were in a fund, they couldn't do that. They still want to have some control. That's really the only control they have, is say yay or nay, I want to do the deal or not. Otherwise, they're not really involved anymore after that. But they still want to say yay or nay for the deal, most cases.
All right. So where do you think the trends are headed with foreign investors? We've already identified the migration away from Chinese investment because of overseas influence, right? Because of their policies over there, directing investors here moving towards Japanese and Singaporean and South Korean investors, etc. But where's it headed? What do you predict is going to be the future, say in the next 3 to 5 years?
Well, for sure, within the next couple of years. I think we're still going to see the same amounts and more of these foreign investors. And one of the reasons also why we're seeing more of it now is the hedging costs, because a lot of the institutions, especially if it's the high net worth, families and so forth, they're not so worried about the hedging costs because that's not their thing. They would take that risk. But when we talk about institutions like pension funds or insurance companies from Singapore or South Korea or Japan, they have to hedge for their own reasons, and the hedging costs keep coming down. For them to hedge against the U.S. currency. So, and what I've been reading is they expect the hedging costs to continue to come down over the next year as well. Because it used to be, I think it was like, if it's like I think it was like around 2% additional interest rate, so to speak, of the hedging costs. Now it's like less than 1%. So they expect that to come down, so it's cheaper from the hedge. deals and they can be more competitive.
Michael, explain that to me. I have to unwrap that a little bit. Hedging what again? What are they hedging exactly? Sorry, I'm not quite.
They're hedging, their currency hedge, their currency versus the U.S. currency.
Oh, I see. Okay. So, all right. So, got it. Because I remember doing that with my own capital when I was living in Japan. And I never knew whether I wanted to be paid in dollars or in yen. So I actually ended up negotiating 50-50. I had a set amount in both currencies. And that way I figured it doesn't really matter which way it's going to go. At least I'll be happy on one side and not on the other. It'll balance out.
Right. Balance that, right.
Right. So let's wrap up with some kind of sign-off questions, if you don't mind. Some kind of high-level thoughts for anybody who is about to engage, either through you or otherwise, with foreign investors. Describe the process, will you, of raising capital from foreign investors. Again, I just through my own lens, I remember it was a very unusual experience first dealing with Japanese investors when I did. I didn't speak Japanese then. I do now, but I do remember thinking the customs were foreign. And it took a while to get used to that. So give me some advice give advice to somebody who's about to talk to Singaporean or South Korean or some foreign investor.
Right. I mean, that's a really good point. I mean, the culture is totally different than U.S. culture, or customs in terms of the way they do business. I mean, in most cases, we've been doing this for years, and we've gone to Singapore, Korea, South Korea, and Japan, and and also in the Middle East, for years. And the way that they are accustomed doing business is that they don't, you have to get to know them. Sometimes it can take a long time. You have to go to dinner with them or go to their little, their personal events they have in South Korea where they have, it's like I forget what they call the rooms, but it's, we go out and you have a drinking party, so to speak, with them at night to really get to know them and bond. And it takes time to do that. And you really have to do that first before you can even get in the door of your deal. Like, I always compare it to like this. Like, if you have a deal, like a good deal in the U.S., you could take it to anybody here on Park Avenue by my office, any of the funds, and they would talk to you, even if you didn't know them, if it was a good deal. In foreign countries, Asia and the Middle East, it doesn't matter how good the deal is. They're not going to talk to you first until they know you, like me as the broker, not even the owner, for me to present it to them. It just takes a process, to really get into certain investors, for them to look at your deals and to fund it. And we've been doing that for years. So we have a good relationship with all these investors. And a lot of times what happens as well, at least with us, is, we work with one investor, either a high net worth family overseas or even institution, and everybody knows everybody in every country because the countries are small. So everybody knows everybody. So if you do a good job and they like you, they introduce you to their friends. Even if it's an institution, they introduce you to their friends at this institution or this high net worth family, and that's really how we got a lot of our investor relationships overseas. It's just from referrals from investors that we dealt with who like what we did, and they would refer to us to our friends, and that's really how we cracked the foreign investors, because it was time consuming to really do this over the past 10 years. So it's now it's coming to fruition, obviously a lot, and we continuously, obviously, by the way, we still get a lot of referrals from investors to introduce us to their other friends. I mean, it just keeps happening, over and over again, because there's so many, especially on the family office aspect. I mean, a lot of institutions, worldwide people know the institutions, but the family office aspect, there are a lot of, billion-dollar family offices out there that no one really knows about because they're very private. People don't want to know, who they are, so they're very private. And how you crack into that is you get introduced by another family office that they're friends with, and that just keeps multiplying and multiplying. That's how we found all of our family offices overseas, is mainly through referrals from other family offices, that they're friends with.
Michael, this is a very important point that you make. So if somebody is looking to raise capital from foreign investors and they're working with you particularly, does the introduction through you cut any of that? I'm going to use an American expression, or at least a Western expression. Does it cut that red tape? Or is that sponsor still going to have to spend time to get to know the investor on a one-to-one level, etc.?
I mean, it definitely cuts a lot of red tape because, it gets them in the door to talk to the investor, to do the investment. But the investor's still going to want to, meet and that would definitely fly here. You don't have to go to Korea or Singapore. They have no problem coming here to meet you, and they want to see your office. But it definitely cuts a lot of red tape, and we've done deals with foreign investors within 60 days. From introducing them to the deal plus the sponsor, and then 60 days later we close. So it's not a long drawn out process because we've cut a lot of that red tape out already by our relationships. We've earned the trust from these investors to know that we're going to present them with good sponsors and good deals. So they trust us in that aspect to spend the time, with someone we introduce them to. They would spend the time and underwrite the deal and the sponsor faster than they would if the sponsor called them directly. Because a lot of times the sponsor
Right.
try to call directly and they get nowhere.
That's right. You find a number on the website. Excuse me, hello.
Right. Right.
Can I speak to the boss, please? I want to see if he wants to invest
Right.
in my deal.
Right. Exactly.
Doesn't work like that.
That's not what I mean. It works like that on Park Avenue in New York, but not overseas.
Right. Exactly. Well, even there, though, people, they want to know eventually who you know, right? Who knows this? No one's gonna invest with a total stranger, right? You might be a
100%.
stranger on the day you walk in, but they're gonna figure out who you are before you leave.
100%. You're right.
Right. All right. Very interesting. And you've touched on it. The other question I was going to ask is, it's a lengthy process, but you've said that it's not. So I think that's reassuring as well.
Right. I mean, the one misnomer that people think about foreign investors, which historically maybe 3-4 years ago, that they were slow. They're not slow anymore. Like I said, we closed the deal in 60 days with a foreign investor, and we're doing a deal now. It should be 90 days. It's not a slow process anymore because they're motivated to invest in the U.S. and they realize that they want to invest in U.S. deals. They have to react on U.S. timing. So that's one thing that the foreign investors have gotten accustomed to from our side is they know they have to be fast. So that they've stepped up to that point.
So let me actually ask you this, and we'll wrap up. I don't want to keep you any longer, Michael. I know you're busy. So is it worth somebody's while? And will you do this, actually? Somebody who has a pipeline, but who doesn't necessarily have an active deal today, to get to know an investor, tour them around their buildings, right? Get to know them, have them fly out, look around, talk about numbers, and establish that relationship so that next time there is a deal, when they really have to move quickly to be decisive, that investor is already understands who they are and is ready to invest, predisposed to invest with them. Is that an approach you can take, or do you have to have a deal on the table?
No, we do that all the time. I mean, we sometimes we go to Asia, sometimes they come here. We do that all the time because it's it's a process. They have to understand. Like I said before, half their underwriting is the sponsor. So, plenty of times we've done that, and it's been successful in doing that because once they like you and they know and they're comfortable with you and they believe your track record, you have a good track record, and they see that, I mean, they're gonna easily do your next deal if you've already gotten through their underwriting of the person that they're dealing with. That saves time, but
so you'll tee up a sponsor. If you see a sponsor that you like, who's credible, you'll tee them up with a foreign investor, even if there isn't a deal on the table, just to get them ready for the next deal when it shows up.
Right. I mean, a few times we've actually have gone to Asia, recently, where we took a strong, local partner. We took them to Asia and we basically took them around and they met all the investors that we, pretty much all the big guys that we knew, so they can really learn their culture and also meet all the guys who actually could invest in our deal. And ultimately, we zero down to the one that's the most likely candidate, but we have no problem about, introducing them to the investors. And there's always one guy that steps up that's ready to do something, from it. So
fantastic. That's really interesting. Well, next time you have somebody wanting to go to Japan, My Japanese is a bit rusty these days, but it come quickly. Give me a call. I'll carry your bags.
Very good. That's good because I don't speak Japanese either. So it's
I actually ran a division. I did a lot of real estate development when I lived in Japan. I ran a division of Universal Studios, Paramount Studios, and JV with Universal. So I actually learned to speak pretty fluently. I gave press conferences, and negotiated contracts in Japanese. Couldn't do that today. I could probably order lunch, but I can definitely, still make contact. That's, pretty well, probably. Michael, any last words of advice or thoughts that you might want to share with somebody about the benefits of looking seriously at taking on foreign investors? The benefits and any of the cons that you might have, just to sign off with.
Well, I mean, I guess if obviously if people want a cheaper source of capital to do their deals, we're very good at making those marriages, so to speak, but by working with our investors. But it's a process. If you're really serious about if you have a pipeline of deals and you're really serious about doing a lot of deals, and you want to tap into this foreign capital, I think people need to start sooner than later, because it is a process of getting to know you. But one thing you can pretty much be assured of is once you make a good relationship with a foreign investor, they're pretty much are going to be your investor for every deal that you want. I mean, because they're very loyal. They expect the same from the local partner as well. But the foreign investors are very loyal, and if you do right with them, they'll do right with you, and they would be potentially a good long-term partner, which has happened with a lot of my clients. They just keep funding their deals over and over again. It's a lot less work too for the local partner. They can just make a phone call, so to speak, and then they can have their money, relatively quickly.
Michael, as always, an enormous pleasure to talk to you. Thank you so much for being on my podcast again today.
All right, thanks for inviting me.
That was Michael Campbell of the Carlton Group. And let me reiterate for my listener, Lara Macajon, the highlights of today's call. You can raise equity from foreign investors who write huge checks at lower cost of capital while retaining full autonomy on how you run your deals. Remember, you still have to have a good digital presence, especially with investors so far away. So to find out how to build a cutting-edge digital marketing system for attracting investors to your deals, sign up for the free whiteboard workshop on the podcast page for today's episode, where I walk you through exactly how to do that. You can access that at the podcast page for today's episode at gowercrowd.com. All right, that's it. Thanks for listening. And thank you, Michael Campbell, CEO of the Carlton Group, for joining me again today. It's always a pleasure having you on the show. Thank you. That's all for this episode. I'll see you next time. And for now, this is Dr. Adam Gower signing off.